What's going on, everybody? Chris Naugle coming to you with my friend Christy Van from Vantastic. What we're going to do today is we're going to dissect the infinite banking concept, but I'm going to take you back to the origins of how I learned about this and how it was such a mindset shift for me. And then we're going to wrap the whole thing up with how simple this really is. It just involves changing one thing and adding one step. Let's dive in. I'm super excited about today's because we're going to go back to making it very simple in terms of like how I learned this process and how I learned it while I was a financial advisor. I even pushed back. So that's what I want to do. I want to kind of just take it back to the beginning for me and explain how I heard about it, what it did to change my life, and just very simple ways that people can use this.
Okay. And you know what? I just had 2 more of my own policies set up, did the funding on Friday, and I'm jumping up and down on the inside because I just feel like that this is something just like velocity banking that people had no idea about. And you know what? I think you're a godsend. People are telling me that I'm a godsend to them, and I appreciate that. And, I thank the Lord for the wisdom. But when I pray for wisdom every day, I feel like that He led me to you. And I reached out to you. You didn't hunt me down. I was like, I got to talk to that Chris Naugle because I just feel like there's something there with this infinite banking concept. And you have really cleared up so many things for me. And I'm so appreciative to you for that because I wouldn't be as comfortable as I am right now with the future had you not come into the picture. So, I just want to let everybody know that this guy's heart is in the right place. I had to develop a relationship with you just so I could make sure that, we're on the same page with serving the people. And I feel like that, the last several months here that we've been actually working one-on-one together, that I've seen your heart for people, and I think that's beautiful. And I think people need to see that you actually care about what we're talking about, and you're not just trying to sell something. I'll get that comment sometimes. Well, what does Chris Naugle's team make for this? What's their fee to help us? And I'm like, you don't understand. This guy has the team set up so that they can help you get into the right policies. This is all just what every insurance company does, except Chris Naugle's team is telling you how to get in there correctly, building these specially designed and engineered policies so that you are getting the cash value out of them. So thank you again. I wanted to throw that in there because I know people love to see the heart of people, and I'm just here to tell them that I have seen what you and your team are doing. And I think you're wonderful. And I want to share you with everybody so that everybody can understand what this infinite banking concept is all about.
I love that. And, transparency is really important to me. And, it wasn't important to me. And actually, it wasn't something that I lived when I was a financial advisor. I spent 16 years as a financial advisor. We were literally trained to kind of hide what we made on different things. And I'm not going to say that's, every advisor or the industry, but I can tell you right now, like the firm I was at, we would talk about that last. Now we talk about it first. And, anybody that ever wants to know what we get paid, all they got to do is ask myself or one of the mentors. But I also created a video on my YouTube that has gotten a lot of views, and it's how I lost $534,000 on the infinite banking concept. So now when people hear that, I'm like, oh my God, I didn't think you could lose money with the infinite banking concept. You're right. You can as the client, but we as the advisors have to take a haircut, a reduction in our commissions of anywhere between 60 to 90%. That video explains exactly why we take a very reduced commission. And it just goes back to the age-old law, because it's a universal law. If I give, I get. Okay, so I have to give first. And you always need to start with the give. So when we're doing this, what we have to do is design the policies to basically make it so that our clients have more cash value. That's the give. And because of that, we get more clients because it works 100% of the time. But if I can, let me just kind of take you back. And I was just thinking about this a second ago. This is over a decade ago that I learned about this. Now, over a decade ago, I was a pro snowboarder. I was a financial advisor. I was about 13, 14 years in as an advisor at this time. So let me just kind of go back to that. And now I'll never forget this day. It was a day I was out in Utah. I was snowboarding. There was a competition, but I was also just getting into my real estate career with my wife. We were flipping houses and we were just starting to do it. So clearly we needed money. So when we find a flip, we always needed to borrow money. Now we could have went to traditional banks. We could have went to hard money lenders, but I had started figuring out private lending. And there was this guy who I knew from prior masterminds I'd gone to. His name was Mike. Now, Mike came from a multi-generational real estate family. They had lots of money and they'd done thousands of real estate deals. So when I was out in Utah, I actually had a deal, and me and my wife got the deal under contract right before I left. And I called Mike up when I was out there and I said, hey, Mike, I'm in your backyard. I'm in Salt Lake City snowboarding. I was wondering, can we get together? I have a deal I'd love to show you that we need to borrow money for. And he said, yeah, Chris, no problem. I'm glad you're out here. Let's meet at Cheesecake Factory, downtown Salt Lake City. Never forget it. It was right down in the center of Salt Lake City. I met him. We got our table. We're sitting there. I'm starting to show him the deal. And he had lent on other deals. So I knew that this deal would have probably fit his criteria. And for some reason, I don't know why, but I just asked him, I said, so Mike, how do you lend all of this money? Because I was curious, right? Like the ultimate in real estate is becoming the bank. So I wanted to learn as a financial advisor, like, how do I become the bank? And that's all I said to him. I said, so Mike, how do you fund all of these deals? I had ideas in my head. I'm thinking, oh, he lends from his HELOC, he lends from his self-directed IRA or whatever. And he very quickly answered me. He said, Chris, I lend from my private bank. And I heard that. I'm like, whoa, Mike, you got a bank? Like, why are we at Cheesecake Factory? We could have just met over your bank. And I think I said something, after we're done with this. I said, Mike, can we go check out your bank? For some reason, now I wanted to see his bank. And he said, no, Chris, I don't have a physical bank. I just mimic what banks do. So now, just like all of you, you'd be sitting back and be like, okay, so keep going. So Mike begins to tell me about his private bank. And he starts by saying, Chris, I just changed where my savings goes first. I don't put my savings in a traditional bank. I put it into my own bank. And my own bank pays me guaranteed interest. So now in my mind, all I'm doing in my head is I'm compartmentalizing this, right? Like over here on the board. First thing Mike said, guaranteed interest. So when I put that in the little box as a financial advisor, I'm thinking, okay, CDs, fixed annuities, treasuries, like guaranteed things. Then he goes on and he says, and I get paid dividends. So now what I'm doing is now I'm saying, okay, dividends and guaranteed interest. What gives me dividends and guaranteed interest? And I'm thinking, and now I'm starting to run out of solutions. But he keeps going and he says the guaranteed interest and the dividends grow in a tax-free environment. So the only tax-free environment I knew of at this time that came to my mind is a Roth. And I'm like, well, a Roth could get guaranteed interest if he had it in a fixed annuity, but that wouldn't pay dividends. So maybe he's got a fixed annuity or CDs plus stocks that pay dividends, but all of it was guaranteed. So I'm like getting confused, just like some of you are. You're probably trying to do the same thing. And he says, not only does it grow guaranteed interest plus dividends in a tax-free environment, it's protected against judgments and liens. So now Mike's telling me if somebody slips and falls on his property, they can't take the money in his private bank, and it's private. So we made sure I knew that it was private. It didn't have to be reported every year. And he said, if I ever were to die, my family gets a legacy. They get a big payout for more than what's in my private bank. I am so confused at this point when Mike's telling me all this. But then Mike goes one step further, and this is where he really blew my mind. You see, my mind was so conditioned around traditional finance. All I knew was what I'd been taught up to that point, which was a lot more than the average person knows. Because remember, I was a financial advisor. I was actually one of the top financial advisors at the firm. So I knew a lot about different investment strategies and different places money can go. But Mike had me stumped. But now he literally just took that last fatal blow on this one, because he said, Chris, what I do is I put the money into my private bank. So remember, Mike's got me understanding this private bank that has all those things. And he says, Chris, when you come to me with a deal, what I do is I take a loan from my private bank and I give that money to you for this piece of real estate that you're going to do. Sorry, I'm just trying to draw it out so you can see the visuals. So he's got all this going on in the private bank. He takes a loan and he gives it to me on my real estate deal. And then he says, and then Chris, you pay me interest, which Mike charged 15% interest. And then Chris, what I do is I take that interest that you pay me and I don't put it in a traditional bank. I put it back in my private bank. So in my mind, just like some of you, hopefully all you did is you literally just saw a circle. The money starts on one side of the circle, that awesome private bank place. The money then goes over here, lends it to me on my real estate deal, which I then pay him 15% interest. He takes the interest and he puts the interest back in the same place where it came from. Now, here's where he confused me and literally piqued my interest to the utmost level. He said, Chris, when I take the loan from my private bank, I'm not using my money. My money stays in the account, earning guaranteed interest and dividends, tax-free, protected in a private place with a legacy. So all of that's still happening while he lends the money out. And then he says this, so Chris, I get to earn uninterrupted compounding interest on all of my money, but I get to make money twice on the same dollar. Just gonna pause right there because if your mind was like mine was, it just exploded. Because I thought I knew everything there was. And now Mike just told me about this thing, which sounds hocus pocus, sounds too good to be true. I'm like, there is nothing I've ever heard of that could do that. The only thing I'm trying to articulate in my mind is I'm like, could this be a HELOC? He does have a lot of real estate because in a HELOC, he's not using his own money. The bank is lending him money against his equity. But when he takes the money out, he's not earning interest on it. But maybe Mike's talking about the appreciation on his property. You see, I'm trying to make all this work in my mind, but that final thing he said where he takes the money out as a loan. Now, remember, I'm kind of fixated on this loan, so I want to understand that. He takes the money out as a loan and still earns interest on it all. So let's just put some numbers to this. If it was $100,000 that he had in his private bank, and let's just say his private bank, I'm just making a number up, but this is pretty close to where it is today, was 6%. He could take a loan for 5%. Okay, notice how he's earning more on his money than what he's paying to use his money. So he is doing what a bank does, because remember he said he's got a private bank. So he is making a spread, 6 minus 5, hypothetically. But then he lends that money to me at 15. So then he takes the 15 and puts the 15 back in the same account where it came from. So he's making money twice on the same dollar. This is my first experience with the infinite banking concept. Everything I just explained to you is a process because we went through it, right? Changed where his money went. Step number one. How he used the money is he took a loan from his bank. Step number two. Step number three, the money went out to work for him by lending it to me in a first lien position. Step number three, he made 15%. Step number four, he took the interest earned from that private loan, and he didn't put it back in the traditional bank. He put it back in his bank. Because listen, if you had a bank, why would you ever deposit money in somebody else's bank? You would always put it in the same bank, your bank. He was doing that. And all he did is just changed the order of how his money worked for him. Now, the biggest thing that I didn't understand at this time is I didn't understand what it was. So naturally, the next question I asked Mike is I said, Mike, listen, I'm a financial advisor and I've never heard of this. This is amazing. You have to teach me how to do this because I could teach all of my clients. I could make a fortune doing this. And then Mike says, what do you mean, Chris? All advisors know what this is. Every one of you know what this is. And I said, I'm thinking, oh, yeah, I guess I do know what it is. But I'm thinking in the back of my head, I'm like, I have no clue what this is. And Mike says, all it is, Chris, is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. You see, what he did when he said that was destroyed everything that I thought I knew about whole life. Everything that I thought I knew about how it worked, and everything I thought I knew about finance in general. You see, as a financial advisor, they never, ever teach us about banking. It's almost like banking is like a forbidden secret, because everything I just said, that's banking 101, right? If you owned a bank, you would deposit your money in the bank. And if you owned a bank and you needed money to lend to somebody like me, you would take a loan from your bank and give that money to me, which means your money never left the account. You're just using the reserve. And also, some of you are probably confused where this loan comes from. Well, it's simple. In a whole life policy, there's also a death benefit. Remember, Mike said that was the legacy part. If he died, his family got a big check. He didn't talk about that much, but that is exactly what happened. So when he takes a loan from the life insurance company, the life insurance company is giving him a loan against his death benefit. So remember, we started with $100,000 in the policy. This is just an example. Started with 100, but he took a loan for 100,000 to lend that money to me. I'm just keeping this simple. So whose 100,000 did Mike use? The insurance company's 100,000. The insurance company gave Mike money from their general account. And on a screen, on like a spreadsheet or whatever they use, all they did is they went into the death benefit. Let's just say the death benefit's $500,000 in this example. They subtracted 100,000 from the $500,000 death benefit. So now if Mike, after he did this, were to die, his death benefit's only 400, not 500, because he advanced 100,000 of the death benefit. Now, this is really important, folks. So please pay attention, because a lot of times when people get on the phone with our mentors, they think that they heard something that they didn't. I did say you are taking a loan from the insurance company, and I did say the insurance company is giving you part of your death benefit, but the insurance company is only going to give you a loan for the amount of cash you have in your policy. In this example, Mike had $100,000 in cash value. So if he took a loan for 100 grand, the insurance company is collateralizing the loan against his death benefit with his cash value. You see how simple this is? When a bank makes a loan to you, okay, just pretend this is how banks work, because this is how they should. Forget about fractional reserve banking. But if a bank took $100,000 in deposits from you, and you know your neighbor came in and wanted to buy a $100,000 car, the bank approved them and took your $100,000 you put into the bank as deposit. They took that 100 and they lent it to your neighbor for this new car. Your neighbor then pays principal and interest payments back to the bank, which they deposit in there. But if the bank didn't have $100,000 of deposits on record, they couldn't have lent $100,000 to your neighbor, right? You can't lend something you don't have. So therefore, the same exists in your banking system. If you don't have cash value, money in your policy, which are your premium deposits, then you can't borrow anything. But see, that already should have made sense. But does everybody understand what I did? I kind of broke this down. You're doing the exact same thing a bank does every single day. And I want to prove one other thing too, and I want to do it by sharing a screen. And I think this will kind of really bring it home, because if we're going to learn the infinite banking concept, which is nothing more than a banking concept that allows you to become the bank and allows you to take back the banking functions in your life, we have to change our mindset around how money works. So I'm going to show you this slide right here. Okay. And this slide is going to show you how banks operate every single day. All right, let me see here, share my screen. So remember, when you go to a bank, let's just kind of go through how a bank works. Let's just say you had 100 grand and you want to deposit it in the bank. You go into the bank, you make a deposit into the bank. In return, the bank pays you interest on your deposit. Now, let me ask you a question. Christy, I'll ask this to you. If you put 100 in a bank and they paid you 4%, but then you took $100,000 out of that same bank, you withdrew your money, how much would the bank pay you in interest?
0.
Right, because you took the money out. But let's not pretend that happened. You keep the money in there because you want this interest rate. What does the bank do? Well, the bank immediately takes your money and lends it out, because that's what banks do. And we already know this. But to prove that you're not in control of your deposit anymore, you should ask this question. Does the bank have to call you and ask your permission to lend the money, like I'm showing you, on this mortgage, this home mortgage here? The bank does not have to call you. The bank never has to notify you because you gave up control of your money to the bank. Therefore, the bank is free to do with your money whatever they want, as long as they have the money to give back to you when you need it. Okay? So now the bank lends the money to this at 7%. Remember how I explained that with Mike's policy? Remember, he was making 6, paying 5? He was making a spread. Same thing here. In a traditional bank, they pay you something, interest, we'll use 4, and they charge somebody 7 on this. What did they make in the middle? A spread. Mike did the same thing, right? Mike did the exact same thing. And then the person who sold the house gets that $100,000 and puts it back into the bank. The bank then immediately returns that money back out in the form of another loan. And the interest rate's going to go up because the risk goes up. A car loan is riskier than a mortgage loan because a car has wheels. And now they got to chase the car around the country if they need to repo the car. The house never gets up and moves. So you can see more risk. So they charge 8%. So again, let's do the math. If they're paying you 4 and they're charging 8, what are they doing? Well, they're making a 4% spread. See how they keep doing this? They keep making a spread. And then they just keep doing the same thing. Car dealership puts it back in. They lend it back out at a higher rate for a home remodel. Contractors get the money, put it back in, and again, spread. And then the bank lends it back out on a or a debt consolidation loan. They charge 12. Credit card gets paid their money, puts it back in the bank. So in this particular example, the bank took your money in, paid you interest on your money, and then lent your money out numerous times, and every single time the bank makes a spread, right? So if we're really following what's going on here, then let's do the math on how much the bank actually made, okay? Let's go into it. Here we go. There's all the spreads that the bank made. After paying you your 4%, the bank made 3 on the house loan. They made 4 on the car loan. They made 5 on the home remodel loan, and they made 8 on the debt consolidation loan. So if we put that up and add that up, that's 20%. So now how much money, or how much more money, I should say, did the bank make than you? You made 4 and the bank made 20. How much more did the bank make than you? Now I ask this, Christy, and you've heard me do this live. You've seen me do this on webinars. I ask this all over the country. And very rarely does anyone ever get it right. Because most people inherently, they want to do the math like this. And folks, as you're watching this, I bet you're doing the math. How much more in the form of a percentage did the bank make than you? With the math being right on the screen. People will most of the time take the 20 that the bank made and subtract the 4 that you got paid in interest. And they will say 16%. But that's not right, because remember, we already factored out the 4 that they're making or that they're paying you. So that's already out. This is net that they made. So the real way to do this would be to take the 4% they're paying you, divide it into the 20% that they're making on your money. And what do we get? 5 times more than you. 500% more than you make. You know, if you go to this right here, BauerFinancial.com. BauerFinancial.com, you can look up any bank for any time frame, and what it will show you is it will show you how much more the bank made than you. And what you'll find is exactly what I put here. There is not a bank in this country that makes less than 400 to 1,300% more than you do on the deposits that you leave there. Now, that's also assuming, literally, you also have to make one more assumption. That's assuming that the bank actually pays you interest on your money. Christy, you deal with thousands of people. How many times that you meet with people do you find folks that have a bank account that the bank is paying them interest on their money, let alone 4% interest?
Very, very little. I mean, we don't even talk about it. It's so little. So the point being that when I see people with money sitting in their checking account, especially, you're like, oh, wow, that's such a waste, such a waste. But
yeah, so
it's such good information. Go ahead.
No, I was just going to say that's absolutely correct. So, we've just been shown our whole life that that's what we're supposed to do with money. We're supposed to take our hard-earned money and we're supposed to give it to the banks, and the banks may or may not pay us interest, but we just leave our money in the banks. And then what do? We go out there and we use the bank's money. We borrow money from the bank to buy our cars, our houses, our boats, even our vacations in the form of credit cards. We use the bank's money and the bank charges us interest. How much interest? It doesn't matter, but I will tell you this. The interest that the bank charges you on any loan you will ever get from them will always exceed the amount of interest they pay you. So if they're paying you 4, just know you probably can't get a loan from that bank for any less than 6. Otherwise, the bank wouldn't make money. So folks, the infinite banking concept, this was the aha that moment that I had when I was with Mike. I wanted to be the bank. I wanted to mimic what banks were doing. And I bet you now, after I showed you that, the banks make 400 to 1300%. And if I asked you what business you want to be in, you should say the business of being the bank. And that's all you got to do is reverse engineer what a bank does, and you do it yourself, just like Mike. This was the moment that I learned. And here's the other thing, folks. Mike actually, when I asked him to teach me this, said he can't. He said, I use this, but I didn't come up with this. I didn't learn this myself. I was taught this from this guy named Brent. Now, I was a pretty smart, logical guy. Before Mike even got Brent's name out of his mouth, I said, give me his number, to which Brent did. He gave me his number. And after I left that Cheesecake Factory, which just so you all know, after Mike kind of got done explaining that, I couldn't even think about the real estate deal. All I wanted to do is get out of that restaurant in my car so I could call this guy Brent, so Brent could teach me how to be the bank. And I did. And Brent answered. Second call, second ring. And I said, Brent, I just met Mike and he showed me this and this and this and blah, blah, blah. And I'm a financial advisor. I must have sounded like a blender with its top off. And then all of a sudden, Brent stops me kind of abruptly. He says, whoa, 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 hold on a second. Chris, I'm glad that you met Mike, but have you watched the 90-minute video? To which I'm confused. I know nothing about a 90-minute video. I don't even know what the heck this guy's talking about. And I said, no, Brent, I haven't, but doesn't matter. I'm a financial advisor and I understand. He stopped me again. And he says, Chris, I'm going to send you a text with my 90-minute video. Watch that video. And when you're done watching that, then we can do a call and I can walk you through how you can be the bank. That's how the conversation went. I was kind of upset. I almost felt insulted. I mean, I'm a veteran in the financial advisor world. And now I got to watch this video. So folks, what I'm trying to get through to all of you is this is so much about mindset. Yes, the infinite banking concept will allow you to change your financial future. Yes, the infinite banking concept will even allow you to get all the money back for every car you ever buy, drive, and own. But none of it will work if you don't change the way you think about money. Now, Christy, let me just ask a couple more questions to the audience here, because these are myths, and very few people get these right. So real quick, I'm going to ask these, and then I'm just going to give the answers. I asked this to the stages all across the country. And the first one is, what is the definition of money? Now, this is a 50-50 shot, folks. If you know what the definition of money is, put it down in the comments right now. Exchange, right? Money is nothing more than a means of exchange. Great, we got that one right. Now let's make this a little more complicated. The second question, what company in the world, we'll just make this worldwide, what company in the world uses compound interest? Go. I'll bet many of you in the comments are putting bank, some of you are putting Wall Street or financial firms, but the answer is none of them. There's not a business in the world that uses compound interest. Now let me explain that. I kind of already did. You would most think that a bank is the one that uses compound interest. But to earn compound interest in the general sense, one would have to take money, put it into an instrument, a place where it's going to earn, and leave it sit there so that it can compound, right? Remember that wheel we just looked at, that bank wheel? Does the bank leave your money in the vault? I'm sorry. The bank doesn't take your money from the deposit and put it in the little vault with the little box with your name on it. I'm sorry. The bank takes your money and immediately is lending your money out. The bank is moving your money, never allowing it to sit still, never allowing it to sit there and earn compound interest. Banks are in the business of charging compound interest. Banks are in the business of paying you compound interest. They do not use compound interest. Car dealerships don't use compound interest either. Otherwise, every car you see on the car lot would be there year after year after year, because that car would have to sit there. The grocery's the same on the grocery store. every single week? No, they turn that inventory. Otherwise, they're out of business. You see, businesses move money in the form of inventory. Every business moves money. I was in Wall Street. There's never a second that Wall Street firms take money and just leave it sit. They're always moving it. We are the only ones who have been taught to believe in compound interest. Now, I'm not saying compound interest is bad. It is the most powerful thing in the financial world, says Albert Einstein, not Chris Naugle. But compound interest does not have to keep your money hostage and leave it sit year after year. But this is what we've been doing. How about this? Are your dollars worth more today or in the future? Hopefully, all of you said today. Some of you were thinking, no, Chris, if I put my money in a 401k and I let it compound, it'll be worth more in the future. Hold on. I didn't ask that. I asked, is your dollar worth more today or in the future? It absolutely is worth more today because your money will be worth far less in the future because of inflation. Do you all know that since the Fed and the IRS, funny how they were both started at the same time, 1913, since then, a printed US dollar has lost over 90% of its value because of inflation. So therefore, it's probable to say that 20 years ago, I could have bought more candy or more gumballs for $1 than I can today because your dollars are worth the most today and they will never be worth more in the future. Final one, retirement accounts. How many of you have a retirement account? 401k, 403b, deferred compensation plan. How many of you have one of those? All of you almost, right? Yeah, we're all going to raise our hands. Now, why did you put money in that retirement plan? Simple question. Christy, why did you put money in a 401k?
Because I thought that was the right thing to do. And I mean, with a 401k, the employer may match, whatever percent you're putting in. My husband even has a deferred comp that's sitting there and losing money over the last 4 years. So I'm anxious to hear your answer to this one.
Yeah, I mean, the reason most people put money in a 401k or a retirement account is because they were told to do that. They were either told by a family member, a grandparent, or the HR team at the company they work for. Like, this is just smart. You've heard it your whole life. Well, you got to save for retirement. So what do we do when we put money in a 401k? Actually, sorry, there's other reasons, and you hit a couple. Maybe you get a match. And if you do, awesome. Let's say you get a 3% or 4% match. That's free money after the vesting period. Great. Some of you are like, well, Chris, it's tax deductible. So every dollar I put in, I don't have to pay tax on that money. Today, you get the pre-tax deduction today. That's correct. But do you have to pay taxes later? Now, another question, are taxes going to be more or less than they are today in the future? Most would say more. Now, today is probably one of those few times where you could sit there and say, well, I don't know. They're talking about getting rid of income tax. Touche. But for most of you, you're thinking taxes are going to be more in the future. We got a big debt that we got to pay off as a country, so they're probably going to raise taxes. So now let's just debunk everything we just went through, because these are all the mysteries of money. First off, we talked that money is nothing more than a means of exchange. Second, we talked about compounding interest. Money has to sit somewhere in order to earn compounding interest. And we discussed there's not a company out there that allows money to just sit lazy like we do. Number three, are your dollars worth the most today? And we all agreed that after you heard the explanation, yes, your dollars are worth the most today. You all said that their taxes are going to be higher in the future than they are today. So then it comes down to the final question. Why did you put money in a 401k, deferred comp, or retirement plan? Because I was told to. Because I get a match. Because I get pre-tax deductions on the money. Because it gets to grow tax deferred. Because I get to put it into different investments. You just defied everything that we just went through about the mysteries of money. Because you're giving up your most valuable dollars today to put them into a 401k where they're going to sit for 5, 10, 15 years, depending on your age. 59 and a half is a magic number. And then when you take the money out of the 401k, you're going to be taking weaker dollars out at a higher tax rate than what you put them in. Not a Roth. So we're just talking about traditional 401ks, deferred comps. So you put in dollars, your most valuable, you take out weaker dollars. You put in dollars to get a tax deduction at arguably your lowest tax rate you're ever going to be at, to take out dollars at a higher tax rate. Now, sometimes when I'm talking, this gets me. Sometimes people are like, whoa, Chris, my advisor told me that I'm going to be in a lower tax bracket when I retire. Oh yeah, I forgot we were taught to tell people that. So in other words, your advisor is telling you that you're going to make less money when you retire than you make today. is that really in line with your goals? Because I certainly, when I retire, I want to be making more than I am today because I want to fulfill and live my life because all those working years, they took so much time from me. I want to enjoy my life when I retire. I want to take my grandkids and my kids anywhere I want, and that's going to cost more. Oh, but then there's the match. Yeah, but the match. Okay, so are you putting in more into your 401k or retirement account than what they're matching you? I bet you are. So, point made. The things we've been told about money are not the truth about money. And I think we just pretty much debunked all of that in that little explanation. So now that brings us back to the infinite banking concept. The infinite banking concept is a process of you taking back the banking functions in your life by changing one thing, and that is where your money goes first. Instead of putting money into a traditional bank, we put the money into a specially designed and engineered whole life insurance policy, like I explained over here. And that specially designed and engineered whole life policy pays you guaranteed interest. Plus, the companies we use have paid dividends each and every single year consecutively, never missing one for well over 100 years. And that money will grow in a tax-free environment as long as the policy is designed properly, which that's how we do it. That's how Christy does it. We design those policies properly. And then what we're going to do is we're not going to just leave the money in the policy, because if any of you are excited about making 5 to 6% on your money, then we need to have another talk. We need to make more than that, because a lot of you, if you're excited about 5 or 6% on your guaranteed money, which I agree, it's more than the bank, okay, on guaranteed money. But over here, if you've got things like debts, you've got credit cards, car loans, all these different things, what is your interest rate on the credit card loans? Well, it's definitely more than 5 or 6%. It's probably like 20%. What is your car loan? Well, I don't know, anywhere between 3 and 8% by today's standard. So is 8% more than what you'd be making in the policy? So why would you ever leave the money in the policy if it could go out here and it could make 8% just for paying off your car loan? It could make 20% just for paying off your credit cards. And then, just like Mike did it, you would take the payment, the money that you were given to the credit cards, or the money that every month you paid to the car loan, and you would redirect that money back to your policy, which is repaying the loan. Because remember, the insurance company does charge you interest on that loan. That is not free money. The interest that the insurance company is paying you or charging you on the loan is less than what they're paying you, yes, but that's still not good enough, because let's make the most we can. And if all we did is we took the money we were given to the credit cards, the money we were given to the car, the money we lent out like Mike does, and we put it back into the policy, all that money is available the next day. You lose no liquidity of the money in doing this. Okay, just kind of think like a bank. Let's think like a bank. If a bank lent out money on that car, and then every month that person makes a payment back to the bank, does the bank not have that payment to use the next day? Sure, absolutely they do. The money came back in the bank. The bank can use that money any way they want. You're the bank. When you make payments back to your bank for the car that you paid off or the credit card that you paid off, indeed, that money is available the next day. But here's what it's doing. It's reducing the loan balance that you have with the insurance company, to which the insurance company is charging you simple interest. Now, I know Christy talks a lot about simple interest, but it is simple interest, and your money is doing what? Earning compounding interest, but not just compounding interest, uninterrupted compounding interest. It's earning compounding interest, but you're still able to use the money. So it's uninterrupted. And every time you make a payment, the loan balance is going down. So therefore, even if the insurance company is charging 5%, they're charging 5% on a declining balance. And you're earning 5 or 6%, depending on the company we use, on an increasing balance, because you're compounding. Do you see how one's going down, the other's going up, but you're losing no liquidity of your money? That's because you became the bank. Now, I want to, Christy, I'm going to pause there. I got one other thing I'd love to show, and I want to really bring this home, because a lot of the folks listening, like, this is brand new to them. And because it's such a mindset shift, I want to bring it back to two things that I think every person watching this will understand. Number one, a HELOC, home equity line of credit. And number two, we're just going to pick on a deferred compensation plan, which is no different than a 401k, 403b, any retirement account, IRA. Well, let's not use an IRA, because we can't do what we're going to do here with an IRA.
Okay, so all of that is great information, but back to my husband's deferred comp. It is sitting there doing absolutely nothing. Like actually has lost money, like I was saying earlier. And he's angry because he said, had I known about the infinite banking concept, I would have been putting my money into that, which is every dime he's putting in there is growing at compound interest. And he said, I could have been using it all these years, but I can't touch it until I'm 59 and a half. Is there any way for me to roll that over or somehow move that into an infinite banking policy?
Rolling it over, no, because you're in a qualified retirement account. You can't move it over to the policy because that is non-qualified. So we don't need to do that. But here's what you can do. Most every single person that has a deferred comp, a 401k or anything, most of them have a loan provision. And if you don't know, just ask HR, ask the 401k provider. You can take a loan against this deferred compensation plan. Usually the rules are 50,000 or 50% of the balance. So let's just assume that your husband has $50,000 available as a loan in his 401k or deferred comp. What he could do is he could take that loan out, okay? And I'm going to do this two different ways, but I'm going to do it in less than 4 minutes, okay? He can take that loan out. If he does, they're going to charge interest. Right now, it's about 8% simple interest, okay? They're going to charge interest on that loan. And then he could take, I'm just going to pretend that he has a truck for 25 grand. He could pay off that truck loan and then take the $500 payment that was being made on that truck and put it back into the deferred comp. Or he could take a $50,000 loan, put it into that specially designed whole life, then pay off the truck, then make the $500 payment back to the whole life and take whatever's needed and put it back into the deferred comp. So you could do it either way. No matter what, you're accomplishing the same goal. But here's the cool part. This interest that the deferred comp is paying you, when you pay that back, so this is that 8% interest that they charge, when you put that back in the retirement account, that 8% is put back into your account. That is not a fee that they charge. That's money that goes back into the account. But now you don't have a car loan. The money, the cash flow didn't change. You're just diverting the $500 back to the deferred comp or part of it up here to the whole life, part of it back to the deferred comp. You could do that. And in doing so, you literally took back the banking functions in your own life. So that's how you would use a deferred comp without triggering the tax wall, because we do not want to pay taxes on the withdrawal from the deferred comp. You could do the same thing, and I know you teach this all the time. Instead of that, you could use a HELOC, home equity line of credit. Same difference. You could take the money out, put the money back, and keep doing that with the HELOC. But you see, here's why the infinite banking concept is such a good addition to everything we just went over. When you take money out of the HELOC, that money isn't earning interest for you at all. When you take money out of the 401k or deferred comp, that money's not earning interest. The only way to earn uninterrupted compounding interest is using that whole life as a stopping place. So that's just one way where you could really do that.
That is awesome. And you know what? The real turning point for me, which I was already sold on infinite banking back at least 15 years ago. I've heard about it for a long time, didn't take any action steps until probably 8 years later, just because I thought you had to have somebody in your area that did that. So when I found a guy in my area that did it, he ended up being a farce. He didn't know what he was doing. He set it up under IULs. I'm to this day so disappointed in him. So my first four were set up wrong. Then I come to your company. You all set it up right. I feel so good. I can see what's happening in my own policies, which makes me super excited. But I think that where the real kicker came, and I thought, oh my goodness, was the two things you already noted. One is I can pull it out and use it. And when I'm paying it back, every month I make that monthly payment, it's available to me to use again within 30 days. And that is just like I teach with lines of credit. And that just like blew my mind. The other thing that was the kicker was that 5% or whatever, 6% maybe that you're paying back into the whole life or to the insurance company for the money that you borrowed, that is coming down because as your balance is paid down, the interest charges are coming down as well every single month, just like a HELOC. And
Exactly.
when that hit me, And I have people sitting with, every day, $10 to $100,000 in a savings account, drawing absolutely nothing. And they have interest being paid out on credit cards and stuff. I was like, this is a no-brainer. Why wouldn't you put the savings into a whole life first, then turn around and withdraw, pay off the stupid cards that you're wasting money on because you already have the money to pay these bills? You just think you have to have that savings account. And if you think you have to have the savings account, then put it into the whole life and let it grow compounding while you're pulling it out and using it. But it's still growing at the same amount that you put in. That is just like, I get so excited talking about this because we just don't know that we don't know. Right? So
Absolutely.
that's been my whole thing ever since, I guess it's been a month ago that you explained how the the repayments that you're paying back to that insurance company is just building your cash flow back up again. And you can turn right around and use it. And I can't even express how you talk about, the lid being off of it's just like, that's crazy. My mind when I heard that, because I'm like, there is no option. There's no better option for taking care of any extra monies for sure that you have sitting around. But even, I have people that are making monthly deposits into their own bank, and it's working for them well. I mean, you're just, if you have to do it monthly, fine. I choose to do it in chunks by taking it out of my HELOC and chunking it into my infinite banking and letting my income work back down my HELOC, just like I teach every day. So the point is that I just don't think the American people are aware that this is even an option. And that's why I have just made so many videos here lately about this, is people deserve to know that your money can be working for you even better than I thought it could be. So I'll forever be grateful to you for taking the time that you have to sit down and talk to me about what these infinite banking policies, the process is, because once that the process is set up, you're just funding it and then using it. And that's what I said. End of discussion. I can't even imagine anything that's going to work better for myself than the infinite banking concept. It's beautiful.
Well, I think the best way to wrap this video up is just for anyone watching this, if you want to learn how to do this yourself and learn how this works above and beyond what we did today. Christy, if you could put the 90-minute video up that I alluded to earlier, and then a link to book a call, and then you can get on the phone with a mentor, and then we'll basically walk through what it is your needs and goals are, and we'll show you how this can solve your problem. Thanks, Christy. I appreciate your time.
Thank you so much. I appreciate the time that you take just to come on here and do this.
I hope you enjoyed that video. And at the end, we kind of gave you that little teaser of how this could work with a deferred compensation plan or a 401k. I'm going to do another segment all about that. So stay tuned and we'll hit that one. Hey, by the way, I mentioned a 90-minute video in there. If you want to watch that 90-minute video, here it is right here. See you next time.